In my many years of teaching the subject accounting, I have come to realize that a lot of students tend to just overlook or commonize this area of the subject: expenses, payments, receipts, incomes. They think they know what it is, but unfortunately they do not. And that is one of the reasons why they have had to struggle so hard to learn accounting. In accounting, one thing is very important: attention to details. You have to know things that are the same and things that are not the same. I have asked a lot of accounting students while teaching in a physical class, and I asked them, what is the difference between expense and payments? And they look at me and say, oh, come on, what are you talking about? I think expense and payments are the same. I said, okay. What about receipts and incomes, or receipts and revenues? I said, well, this is the same thing. When you're receiving, you have a receipt, and you get income, they are the same. And I tell them that, hey, these pairs of terms in accounting are absolutely different. As a matter of fact, the two of them are not even posted on the same side. And that shows you that in no measure do they imply the same thing. Sometimes it could be complementary, though. Yeah, sometimes. So the focus of this lesson is just to let us see very, very clearly what the difference is between expenses and payments on one hand, and the difference between receipts and incomes or revenue. And before we know it, we're already dealing with the implications of the Accra concept of accounting. The Accra concept says that expenses shall be recorded in the period when they are paid for. We start with that. I'll take it again. Accra concept says that expenses shall be recorded only in the period when they are incurred, not in the period when they are paid for. I'll take it again. Expenses should be recorded in the books in the period when they have been incurred, not in the period when payments have been made. So that should already trigger your understanding towards the fact that it's really looking like expenses and payments are not the same. They are not the same. Okay. The same thing with receipts and incomes. The core concept says once again that also incomes and revenues shall be recorded or recognized in a period when they are earned and not in the period when they have been received. That's a core concept of accounting, a core business accounting. So let us see with examples what the clear difference between expenses and payments are. Expense simply means to incur costs. That is what it means. That's the meaning of expense. When you incur a cost, then you have incurred an expense. It is not the same as payments. And at what point do you incur a cost? When there is an exchange of value, you have been able to receive value in a transaction, or somebody has delivered goods to you, or somebody has rendered a service to you. We say that in that case, a critical event has passed, you have received a value, then you have incurred costs. But one thing you have to quickly think about is that it is very well possible for you to incur costs and not make a payment. And that is where you incur expenses on credit. For example, you can make a purchase of goods from a supplier, which is an expense, and then you are not making any payment. So expense has taken place in that transaction, but payments have not taken place in the transaction. I'll give you an example. Let's say I have a dude who always cuts my hair, and I always get the payment every time I go to the salon. But this time around, coming back from office, work, and tired, and I just walk into the salon and say, hey guy, you know what we're gonna do? You are gonna give me the usual service, but right now I have no money in me. So tomorrow morning when I am going to work, I will give you the cash for the service that you are going to render now. So what happens when this stylist dresses my hair, he cuts my hair? What happens? He he has rendered a service to me. He has given a value to me. I have received a value from this guy. So once I receive the value, I have incurred a cost. I have incurred an expense. But have I made a payment? Absolutely no. So I am yet to make a payment, and for that reason, you can see that expenses are clearly different from payments. Then let us first try to talk about the next day. So the next morning, I am going to walk and I go to the shop again and say, hey guy, here is your $500. Here is your $10. Here is your $2 for the service you provided for me last night. And I give him the money. At that point, I am now making a payment, but I am not incurring an expense. You have to know that. So let us see very quickly. Let us see. Payments means cash outflow. That is what it means. And the two of them do not have the same effect on your financial statements, on your accounts. They are totally different. So expense means you have incurred costs. Payments means you have made a cash outflow. Cash has flowed out of your pocket to another person. That is payments. So let us see the effect of expense on the accounts. Expenses will reduce your profit in the business. That's what it does. That's the only impact of expense in your business. It reduces your profit. Now, what does payment do to you? Payment only reduces your cash in hand. You know what I'm saying? Expenses will reduce your profit, but payments will reduce your cash. And let us see how we can test this theory using our little secret here pill model. Don't forget here pill. Do not forget here pill, you have debit and credit. Now this model says expenses must always be debited, and payments must always be what? Be credited. So if the rule is telling you that always debit your expenses and always credit your payments, then it is simply telling you that, hey, in accounting, though they look alike, but expenses are totally and absolutely different from payments. I can be making a payment and I'm not incurring cost. What if a friend of mine approaches me and it says I should lend him the sum of $5,000, and I give him the sum? When I give him the sum of $5,000, I have made a payment to this guy. It's a payment. There's an outflow of cash. But at the same time, I have not incurred any expense. I have only given him a sum of money that he is going to give me in the future, which is going to be a receivable. So, in that case, a payment has taken place, but there is no expense. In our further lessons, we are still going to look and see how payments and expenses flow around the financial statements and get to affect the financial position of the business at the end of the day. So, just this explanation we have had for expenses and payments, we can apply the same virtually for receipts and incomes. Receipts and incomes are not the same thing. Receipt simply means there is inflow of cash. There is cash inflow. That's what it means. So when you have a receipt, it means that money has flowed into your account, money has flowed into your pocket. You have received cash. That is receipt. But then what is income? Income is when you earn a revenue. Income usually happens where you are given a value. You have worked with your organization for a month, you have given value to the company for a month, and now you have earned income, you have earned revenue. But your company might still be owing you your salary. So in the case of income, you have rendered a value. You have rendered a value. Okay? You have rendered a value. You've rendered a value. Let us look at the impact of receipts on a business. When you receive cash, what happens is that it increases your cash. When receipt occurs in the business, you take more cash, then the cash balance in the company grows. That's the fact. So when you receive money, it doesn't add to your profit. We are still going to look at the core difference between profit and cash, and that's why a lot of accountants even struggle with this. You get to prepare your income statement, your profit and loss account, and your balance sheet, and then you discover that the profit you've made at the end of the year is not the same thing as the cash. They will never be the same thing because the two of them are not even in any way related. Profit is a different concept and totally different from cash. So when you collect cash in a business, it doesn't add to your profit. It only adds to the balance of cash you have in that business. And finally, in the case of income, the effect of income on your balance sheet or the business is always that your income helps to grow your profit. Income is what grows the profit, grows the profit. So you usually have income in the form of sales. When you make sales, you have been able to earn revenue, you have been able to generate income, and that adds to your profit. When you earn commission, when you render services to people and you render services to people and they get to pay you for it, or they acknowledge the liability for paying you in the future, then it becomes income, and that is what helps your profit in the business to grow. So these are one of the things that you have to be sure that you really do understand before you can delve into the preparation of the final accounts, financial statements, the cash flow statements, and what of it. So that's what we have for today's lesson. Thank you very much. Thank you.